Okay, so today's topic will be on option strategies. As usual, we will go through some terminology that are new to you, and then we'll talk about some basic positions before advancing to more advanced techniques. Now, today's topics is mostly techniques that you can use as an individual, right? Now, in previous lectures, we talked about delta hedging, Griggs hedging, and all of that. Now, that's quite difficult for you to do as an individual, right? Those are mostly used by corporations. Although, as an individual, you can still use it, but it's going to be more difficult for you because, like, for example, delta hedging, you need constant monitoring, right? So, as an individual, if you're interested in being in the market, speculating, for example, you find that today's strategies are going to be more useful to you. Now, we'll also be looking at a wider range of payoffs. So in the past, the payoff that you look at is essentially just a call and a put, right? So it's either S minus X or X minus S. So today's strategies, because we're going to be combining calls and puts, calls and calls, puts and puts, so and even options with stock. So you see that you're going to have a wider range of payoffs, right, to work with. And you find that some of these strategies are actually quite useful for you as a form of protection, right? You can protect the profit that you made, or you can mitigate the loss that you've made. And some of these strategies would involve combining options with stocks, or you would also be using just calls or just puts, or combining calls and puts. So different strategies that also accounts for a bullish undertone in the market, a bearish undertone, and even if you think that there is volatility in the market, but you're not sure whether it's going to go up or down, because volatility simply means, well, volatile, right? It can go either way. So even if you're not sure, but you think there's volatility in the market, you can also use some of these strategies. Now, for your assignment, you find that you could simply make use of calls or puts, or you could also make use of some of the strategies that we're going to talk about today. So you might want to think about, if you have read the assignment, you might want to think about which strategy that we talk about today can be useful for you. Okay, so I guess the only new item here is the profit, right? Because in the past you only look at payoffs, but now because you're using strategies to profit, you want to be able to calculate the profit from a strategy. And to account for your profit, you of course need to account for the cost, in which case you need to account for the premium. Now in the past we said whether a call or put is profitable simply based on the payoff, right? Which is the difference between S and X. Now, in today's topic, you need to account for the premium that you pay or you collect as well to determine your profit. So N simply denotes the number, your position size. So NC, number of calls, NS, number of stocks. So very simple. Now, if your position size is positive, greater than 0, it means you're long. Okay, and if you're short, then you apply a negative sign to it, hence less than 0. So profit equation, now this is the payoff that you're accustomed to, right? The value of a call is the greater of 0 or S minus X. So in determining the profit now, you need to account for the premium that you have paid or that you have collected, okay? And of course, multiplied by your position size, okay? So this is to long a call, and this is to short a call. When you short a call, always put a negative to the whole term here. So it becomes negative this plus negative, and negative become plus, right? So you receive the premium. In this case, you pay for the premium, and this is simply the payoff of your calls, okay? So the payoff of a put is also the same. The only difference being you switch the X and the S around, and then you account for the put premium as well. Now I'd like to draw your attention to this. So you short or you long a put, right? So the payoff is x minus st minus p. Now if you short a call, what is your payoff here? It's also x minus st, right? Yeah, because it's negative, right? It's a minus sign here. So it becomes x minus st plus c compared to x minus st plus p. So the payoff for writing a call and for going long a put is the same, right? But the difference is that in writing a call, you collect the premium. In going long a put, you pay the premium, okay? So you have to bear that in mind because quite often you can achieve the same objective whether you write a call or you long a put, but the difference is in one aspect you have to pay a premium, in one aspect you collect the premium. So it's always, I suppose, a balance of your cost and benefit. Okay, we go through a few, what I call a profit diagram. So you have to be very familiar with this profit diagram when you look at strategies, because it will help you to visualize where your break-even point is, where your what is your maximum profit and loss. Now suppose you go long a stock here, okay? So what is the maximum profit you can hope to receive? A stock price goes above your cost price, you make a profit, right? As it goes below your cost price, you make a loss. So what is the maximum loss you think you get for a stock if you go long? The maximum loss, when the stock price goes to zero, right? So your maximum loss must be your cost, right? So when do you make a break even? When do you make neither profit nor loss? When the stock price is at what you paid for, right? So therefore the graph is going to look something, sorry, this is your SO. So your maximum loss, this is your break even, and what is your maximum profit? Unlimited, right? Now what if you short a stock? So this is long stock, short stock. What if you short a stock? Let's say this is SO again. When do you make a profit? When the stock price goes below SO or above SO? Below SO, right? So what's your maximum profit? When stock price goes to zero. So it starts from here. So again, this must be your SO, right? When do you make a break even? Must be the same, right? When the stock price is at what you short for, you make neither gain nor loss. So what is your maximum loss? Unlimited, right? Because the stock price can go to whatever price. So once the stock price exceeds the price that you short, then your loss becomes unlimited. Okay, so which is why when you short short sell stocks, for example, the clearinghouse would always demand a higher margin than if you were to go long. Okay, what happens if you go long a call? Let's say at X1. What do you think? When do you make a profit? When S is greater or less than X? So when S is less than X, you stay at a loss, right? So what's the maximum loss you can make? The premium, right? And so it doesn't matter whether the stock price is here or here or here, you're just going to lose the premium, right? Because you have gone long, so you only have the right. So what is your premium? Your premium is, let's call it C1. So when do you break even? S equals to X? Plus the premium, right? So it has to go up here. So it has to be to the right of this, right? So this is your break-even point, which is your X plus C. Okay? What is your maximum profit? Again, unlimited, right? Once stock price goes beyond your strike price, your profit is unlimited. What about if you short a call? Now, if you were to long another call, let's call this x2, okay? Just to show you something. Let's call this x2. What is your maximum loss? Must be the premium again, right? So where is your premium? Is it here or here? Above the first call or below the first call? What is this? Above or below? Below. Some say above, some say below. Which call is going to cost more? Call 1 or call 2? Call 1 or call 2? Call 1 is going to cost more, right? So this is going to cost, so your loss must be less, right? Because you pay a lesser sum. Okay, so it's going to come out this way. Okay, it takes a longer time for you to make a profit, but you also pay a lower cost. So what I'm trying to illustrate to you is that there is a trade-off when you choose the strike price. Okay, so if you choose a lower strike price, you stand to make more profit, right? Because S is going to exceed X1 before X2. So you're going to make more profit, but at the same time it comes at a greater cost. Right? If you choose a higher strike, you're going to make less profit, but it comes also at a lower cost. Okay, so there's always a trade-off. What if you short a call? When the stock price goes below X, are you profitable or are you looking at a loss? Profitable when you short a call. Yes? What is your maximum profit? The call price. And that is a constant, right? So this is your call price. And when you break even, at X, below X or after X? After X, right? Okay, so it's going to come down again. So this is again your X plus C. Very good. Your fundamentals are pretty strong. So what about when you short a put? So again, this is your X. So when you short a put, what happens? When stock price is less than X, do you make a profit or a loss? Okay, we go with long put first. Easier, right? Going long is easier. Okay, so X. So if you long a put, when the strike price is less than, when the stock price is less than the strike price, do you make a profit or loss? This is short call, this is long put. So this is long put, short put. Do you make a profit or loss? Long put. When the stock price is less than X, you make a profit, right? How much profit can you make? So if you long a put, you exercise, you receive X, right? So you must have X here, right? But you paid for the put, right? So you must minus the put. Agree? So when do you break even? Before X or after X? Before, right? Okay, very good. So short a put. When the stock price goes below X, do you make a profit or loss? You make a loss, right? Because the person who long the put is going to exercise it when the stock price goes below X, right? So you're staring at a loss. What's the maximum loss? And what's the break even? Before X or after X? Okay, not, okay. So what's the maximum profit when you write a put? How come it's so quiet now? When we look at the first few diagrams, you're more active, right? What happened? Is put more complicated than calls? Okay, so these are the 6 diagrams that you must become very familiar with. Okay, long stock, short stock, long call, short call, and short put, long put. Okay. Now, when you look at a diagram like this, or when you draw a diagram like this, every time the profit graph crosses the horizontal line, that is your break-even point. So even if you're not sure what that is, below X or after X, if you work out solve the profit formula, you would be able to know as well. Okay, so there are two different ways for you to determine the break-even point. And depending on strategies, it can actually cross the horizontal line more than once. So whenever it crosses the horizontal line, that's your break-even. So you can have more than one break-even point depending on what strategy you use. Okay. Actually, I have one more question for you. So if you long a call, right, and you know that it's unlimited profit, it's limited loss, right, and the break-even point is after X. Now, what happens if the stock pays a dividend? How does that move your break-even point? Is your break-even point going to be greater or less now? What do you think? What do you think? Okay, to make it easier for you, look at stock instead. If you long a stock and the stock pays a dividend, where is your break-even point if the stock pays a dividend? Shift to the right, shift to the left. To the left, right? Very good. What happens if you account for transaction costs? Does it shift to the right or shift to the left? Shift to the right, right? Okay, very good. Okay, we assume no dividends and no transaction costs, but I've just illustrated to you that even if you account for dividends and transaction costs, you can quite easily see where your break-even point is going to shift. Okay. Any question on this slide? So the next few slides are essentially what I've just gone through with you on the document camera. So short stock, unlimited loss, right? So if the stock price is greater than X, your call is in the money, right? So the profit is the payoff, and if it's less than X, it's out of the money, so you lose the premium. Okay. So this is only two profit formula, right? So to find out where the break-even point is, all you have to do is look at the profit formula which has an ST in it. Okay. Equate this to 0 and solve for ST. Okay. So if you equate this to 0, 0 equals to ST minus X plus C. So therefore, what is your break-even point? It must be X plus C, right? If you equate this to zeros. Okay, so stock price is here, right? So equate it to 0, your break-even must be X plus C, okay? Now that assumes that you hold your call or your put to expiration. Now sometimes we don't want to hold it to expiration, right? So if you don't want to hold it to expiration, then you find that time value would come into play. Okay, for a given stock, you know that the longer you hold it to expiration, the less time there is to expiration, and time value is affected. Okay. Any question on this slide? All good? So the 6 basic positions are all very simple, okay? Questions? No? Okay, so go long a stock, take a call, or writing a put are all bullish strategy. Now, if you look at the diagram I drew for you, you find that on the left-hand side is all upward sloping, right? So these are all bullish strategies. On the right-hand side, they are all downward sloping. Okay, so long stock, long call, short put are all bullish strategies. Short stock, short call, long put are all bearish strategies. Okay, so bear this in mind. Not just in terms of how to draw the diagram, also which are bullish, which are bearish, and then I'll show you later on some rule of thumb on how you can draw profit diagram, and with that you can piece together any strategy you want. Now, if you combine any of these instruments here, essentially that gives you all the strategies that we can be looking at. Okay. Now, when you combine these strategies, you're also doing what is basically a hedging of a partial risk, right? Because why is this a partial risk? Can someone explain to me why this is a partial risk? When does it become risk-free? It becomes risk-free if you do a delta hedge, right? And it became risk-free when you do a delta hedge because of two main criteria that we talked about before, right? Because you got the direction correct and you get the hedge ratio correct, right? So not only it compensates with the direction, it compensates fully with your hedge ratio. Now, when you do strategies like this, you're not using your hedge ratio, you're simply using your calls and puts, and in tandem, therefore, you use only your contract multiplier, right? So, for example, one option contract is for how many stocks, right? So that's not your hedge ratio; it's just your contract multiplier. Okay, so it doesn't hedge your, it doesn't make your risk becomes risk-free. So if there's no question, we'll look at some basic strategies. We'll start off with a covered call. So the purpose of a covered call is essentially to limit loss from writing a call or from buying a stock. So you find that the first part here basically describes a covered call. So a covered call consists of going long a put and going short the call. Okay, so by going short a call, you essentially cap the upside of your stock, right? Because if you write a call and the stock price goes up, it gets exercised on you, right? So it caps the profit for your stock. Now, this is also what is called a partial hedging partial risk. Okay, because as I said, you use only your contract multiplier and not the hedge ratio. Okay. So, for example, if you imagine 1-to-1, so for every call you short, you long one stock. So that's 1-to-1, right? So that's not your hedge ratio. Okay, you haven't worked out your hedge ratio. So as a result of that, you're only able to hedge a partial risk. Now the strategy's payoff table would be this: if the stock price is less than X or your call is out of the money, well, stock price remains the stock price regardless, right? At expiration. So the call is worth 0 if it's out of money, and it's worth X minus ST if it's in the money. Okay? Is that correct? Oh, sorry. Okay? So if the call is in the money, the value of the call becomes X minus ST. Yeah? Everybody knows why it's X minus ST, right? Instead of ST minus X, because it's a short call, okay? You put a negative to the whole term. So the payoff becomes ST, and this becomes X, right? But remember, that is the payoff, okay? The profit is something else. The profit then has to account for your premium as well, okay? And has to account for your cost. Okay, so you long the stock, you short the premium, so this is your cost, you collect the premium, okay? So fairly simple. Now this is the payoff diagram. So this is a long stock, okay, the straight line here, and this is a short call, right? So when you combine a short call and a long stock, this is what you get. Now remember this, an upward sloping line with a horizontal line result in an upward sloping line. An upward sloping line and a downward sloping line will cancel each other and give you a horizontal line. Okay? Now look at this diagram. Tell me what you think this is. What does it look like? Based on the 6 diagrams that we see at the beginning of the lecture, what does the resultant, the bold line here, what does this look like? Is this a, what is this? Short put. Why is it a short put? Are you surprised that the resultant graph is a short put? Very good. Put call parity, right? Can you explain a bit more?
Because if it's not equal, it can get arbitrage from it.
Yeah, so how does put call parity result in, gives you this result?
So the call plus stock equals put plus bond?
No.
No?
No. Put call parity is correct, but the formula is wrong.
Okay.
So what is put call parity formula? What is put call parity formula? Maybe we should have a midterm test, right? Then everybody will remember. Somebody said something here? Okay, put plus stock equals to call plus bond, right? Okay, so put plus stock, I'll write it down for you. So put equals to call minus stock, right? Okay, put plus stock equals to call plus bond, right? So if you only want put, then you bring this over this side. So call minus stock, right? So what do we have for a covered call? We long call and we short stock, right? So that gives you a long put, right? So how did we get a short put? Because we long stock and short call instead, right? Okay? Is that clear? So you find that put call parity is actually very useful. Okay, if you find that you want to go long a put, for example, and the put is not trading in the market or it is not at a price that you want, you can always create a synthetic put. Okay, so the profit equation is this. So long stock and short call, right? So profit for stock is ST minus SO. Profit for your call is the payoff of a call and the premium, right? So if position size is equals to 1, it's simply ST minus SO plus C, right? Because you short a call, so this whole term here, you have to attach a negative here. Okay, so it becomes ST minus SO minus ST plus X minus C. No, sorry. So ST minus SO plus C, right? Okay, so find the break-even point again by solving this equation, the equation that has an ST in it. Any question? So you have to be very familiar with the with writing the profit formula, because once you get into more advanced strategy, you find that you have more than a few strike prices. You can have up to 4 or 5 strike prices. So you're going to have more than two profit formula. Okay, every time you have one strike price, you would have two profit formula, right? Because your stop price can be greater or less than the strike price. Now, once you have X number of strike price, then you're going to have X plus 1 profit formula. Okay. So next we look at a protective put. Now again, with a protective put, you take a position where you long stock, long put. So if you long stock, long put, what do you give up? If you long stock, long put, again you give up the upside gain, right? Okay? But then you protect the downside loss, okay, with your long put. So again, stock price is equals to stock price, and the put is X minus ST if it's in the money, and 0 if it's out of the money. Okay, so the profit diagram for protective put is this. Again, you would have a long stock and a long put, right? The result is this line. What is this line again? Long call, right? Again, if you fall back to your put call parity, you can see why the result is a long call. Okay? So profit formula again. The profit for your stock, a long stock, the profit for your long put. Okay? So combine the two. If n is equals to 1, it gives you ST minus SO minus P. If your put is out of money, and then if it's in the money, X minus S. Now, how many of you think that the profit formula is complicated? Are you comfortable with the profit formula? Because if you are, then we can move a bit faster. If you're not, then I will go through the profit formula item by item. Are you familiar? Are you good with the profit formula? Okay, so far, is the profit formula easy or difficult to understand? Okay, I take it as silence means it's a bit difficult, right? Okay, I'll explain one more time. Now, so a protective put comprises of long stock, long put, right? Okay? So now you have two positions. So in determining the profit, you then have to consider two scenarios. One in which your put is in the money, another one is when your put is out of the money, right? So there are two scenarios. So if there are more than one strike prices, then there's going to be even more scenarios, right? So given that there are two scenarios, then you look at the two scenarios. If ST is greater than X, is this put in or out of the money? In or out? Out of the money, right? So X greater than S, your put is in the money. Now, if S is greater than X, what is your profit for your stock? Simply ST minus SO, right? The first component here. Okay? ST minus SO. And what is the profit for your put? Well, if your put is out of the money, then there's no payoff for your put, right? But you paid the premium. Okay? So therefore, it's ST minus SO minus P. Okay, if your put is in the money, what happens? Again, you fall back onto these two components, right? So what do you get? ST minus SO again, because it's in the money, so it becomes X minus ST, right? So ST minus SO minus X. Very good. Why? Because this is a long put, right? So there's no negative. Now compared to the covered call, you short the call, so it's a negative. Okay, so don't get mixed up there. So again, you combine these two, you will get this formula here, right? Okay, ST minus SO plus X minus ST minus P. So the result is X minus SO minus P if your put is in the money. Okay. Now try and do this first with the basic strategy, because when we move on to condos, butterflies, Christmas trees, it's going to be a lot more complicated, because you're going to have 5, 6, 7 profit formula. Okay, so once you get the basic right, you find that even with a lot of profit formula, you should be fine. Okay, always, you only need to remember one formula for your put call parity. Okay, put plus stock equals to call plus bond. Now in practice, however, we usually don't account for the bond. Reason being, the bond is essentially your money in the bank, right? Okay, so in practice, what you want to do is you just account for the 3 components disregarding the bond. Okay. So the profit equation for synthetic puts. Now again, the payoff is always the same, right? So assume one contract size for ease of calculation. So the profit then is minus C minus ST plus SO. I'll write this down for you. And okay, so this is the profit for a put, right? Not a real put, but a synthetic put. Why is it a synthetic put? Well, what is a put? A put is equals to call plus stock, right? Now, if you compare this to the profit formula for a put, what is this? Is this in or out of the money? In or out? For a put, it's in the money, right? So what's the profit for a put if it's in the money? SP minus your premium, right? And if this is out of the money, what is the profit for minus P, right? Now, is this called in or out of the money? Remember, this is a synthetic. There's no put here, right? You only have call. Is this called in or out of the money? Out of the money, right? When your put is in the money, this is out of the money. When this is in the money, this is out of the money. Okay? So you can compare it like this. So the difference becomes very minimal. The difference is simply the interest foregone because you're not accounting for your bonds. Okay? So if the difference is marginal, why do we bother to do synthetic put? Or why do we bother to calculate a synthetic option, the value of a synthetic option? Well, the reasons are more practical than academic. Okay, the reasons are because if the actual option is not trading in the market, you can create a synthetic, right? Now, even if the actual option, whether it's a call or put, is trading in the market, by determining the synthetic options value, you can then determine whether or not the actual put is over or under price, right? So for example, if a put is trading at, let's say, $1 in the market, okay? Now, you want to, in order to know whether that put is over or under price, you must be able to come up with a theoretical fair value, right, to compare. So put call parity is one way to come up with a theoretical fair value. Okay, so you can use put call parity to determine what is the value of the put and compare that with what is traded in the market and come to a conclusion whether or not what is trading in the market is over or under price. and then you can take a position accordingly, right? If the actual put is overpriced in the market compared to what you determine with your put call parity, you can therefore short the put in the market and long the synthetic put, okay, and make an arbitrage profit. Okay? So we've covered two basic strategies. So now we're going to look at spreads. So holding multiple calls or puts with differing exercise. So there are essentially two types of spread that we will be looking at. One is called a vertical spread. The other one is called a horizontal spread. Now a vertical spread is one whereby you take positions in your options by playing on the strike price, okay, using different strike prices. Now a horizontal spread is one where you stay at the same strike price but different option expiration. So you can imagine, therefore, that with a horizontal spread, what you're trying to do is you're trying to capture what? Strike price is the same, time to expiration is different. What are you trying to capture? That's quite easy, right? What are you trying to capture? What do you think, ma'am? Time value, right? Okay, so, and if you're trying to capture time value, you will find that there is no profit diagram you can draw, right? Because you're not holding it to expiration, okay? So we'll first start off with a money spread or vertical spread by looking at a bull spread and a bear spread. Do you want to take time off or do you want to just continue so that we have more time to talk about the assignment? Yeah? Do you need a break? You need a break. So we will look at bull spread and a bear spread using calls. Now remember, in any of these strategies, you can use calls as well as puts. Okay, where a strategy where you use all calls, you can more often than not use puts as well. But you have to weigh the costs and benefits of using a calls and puts. Now time spread, on the other hand, is one where you write options with differing time. Now, when you do that, what you're trying to do is you're trying to play with volatility or time value. Okay? So why do you think people use spreads? Well, wait. What happened? Just give me a... Where were we? Okay, in using spreads, you find that you often can achieve lower risk as well as a lower cost. Now, how do you achieve a lower risk? Because when you combine option positions, you find that the gain you make from one option is often compensated partially by the loss you make from another option. Okay, so you reduces your risk, but you don't reduce it entirely, which is why we say it's a partial hedge. Now, you also tend to lower the cost of a long position because you would basically pay for one and receive the other, right? Now, which is also the reason why if you were to trade spreads, now spreads means you take more than one position, some long, some short, right? Now, outright position means you either take a long position or a short position. So the clearing member or clearing house would always impose a lower margin if you trade spreads to comparing if you trade outright. The reason for that is because of the risk reduction. Okay? Okay, we look at a bull spread. Now, a bull spread is taken when you think that the market is going up, right? But at the same time, in taking a bull spread, it's going to limit both your upside and downside potential. Now, why do you think we want to take a bull spread then? Why do you want to take a position where it's going to limit your upside potential? A bull spread consists of going long one call and going short another call, right? Now, if it limits your upward potential, the flip side is it also lowers your cost, okay? So again, it's always a trade-off between the benefit and the cost. So to take a bull spread, you go long a call with a lower strike and you short another one with a higher strike, okay? So now that you have two strike prices, previously, we only look at two profit formula, right, with one strike price. So now that you have two strike prices, you have three profit formula because the ST can be less than both strike prices, it can be greater than both strike prices, or it can be in the middle, right? So every time you increases the strike price, you have more profit formula to deal with, okay? So it requires initial outlay. Why does it require initial outlay? Well, obviously the strike the lower strike is going to cost more than the higher strike for a call, right? So if you buy the lower strike, you're going to pay more than what you collect for the higher strike. So profit formula when S is less than both strike prices, well, this means that both calls are out of the money, right? So you only account for the premium. Now, if S is in between, then the first call is in the money, the second call is out of the money, and both calls are in the money when S is greater than both strike prices, okay? So again, always write out this formula first and then account for it when S is greater or less than X, okay? So bull call spread is going to look like this. So you long a call at X1, you short a call at X2. Okay, horizontal and horizontal remains, upward sloping and horizontal give you upward sloping. Okay, I'll help you draw this so that when you look at subsequent diagram, it becomes clearer for you. Now, an upward sloping line, such as a stop, okay, plus a downward sloping line is going to give you a horizontal line, okay? Now, upward sloping plus horizontal is going to give you upward sloping, okay? And of course, downward plus horizontal is going to give you downward, right? So upward plus downward, you know, is going to give you horizontal, but if you add another upward, it's going to give you upward, right? Because this means essentially this plus this, right? This is equals to this, and this is equals to this, right? So horizontal plus upward gives you upward, okay? Is that clear? So therefore, with the 6 charts and with this basic rule of thumb, you can construct anything you want, right? Now, if I were to long a call, what do I get? It looks something like this, right? Agree? Long call. Now, if I want this to move this way, what do I have to do? I want this, right? What do I have to do? I short a call, right? Okay, if I short a call, then it's going to move like this, which is what we have, a bull spread, right? Long call, short call. Now, if I long a call, okay, but if I want this to come down, what do I have to do? If I want it to come down instead. Now, if you can picture this, it will help you to design strategies, any strategies you want. So if I want this to come down, how many calls do I have to short? Because if I short only one call, it's going to go horizontal, right? So if I short 2 calls, then it's going to come down, right? But it's going to continue to go down, right? So if I want it to come this way, what do I have to do? long another call, right? Because then it becomes upwards plus downwards, it gives you horizontal, right? Now, long call, let's do another example. Short call, right? Now, if I want it to come down now, what do I have to do? How many calls do I have to short? One, right? Because it's going to go horizontal. So if I short one, it's going to come down. So if I want it to go this way, I simply long another call, right? Okay? So you find that all of a sudden you have so many different strategies, right? You have one strategy here, another strategy. So this is called a bull spread. This is called a butterfly. And this is called a condor, right? So the name also suggests something to you. A butterfly has a small body, right? A condor is a big bird, right? So it has a bigger body. Okay? So you can imagine if you want to develop a Christmas tree, what is it going to look like? Okay? So many different strategies you can create if you understand the drawing convention and you understand the 6 basic graphs. Okay? Okay, so a bull spread. So again, you can determine your maximum profit and your break even. Simply solve. How many profit formula do you have here? You have 3 profit formulas, right? How many of these has an ST in it? No ST, no ST, right? Only one. So if there's only one formula with an ST in it, solve that. You always solve the formula with an ST for your break-even point. So if there's only one formula with ST, you know that there is only one break-even point. Okay? But if this were to come down, instead of going straight, if this were to come down instead and crosses the horizontal line, then you will have 2 break-even point. Okay? You find that you have 2 profit formula with ST in it. Okay, so we look then at what is called a bear spread. Now, a bear spread is taken by buying a higher strike and selling a lower strike. Okay, so bull spread is taken by going long on lower strike, going short on higher strike. A bear spread is going long on higher strike, going short on lower strike. So if you write a lower strike call and you buy a higher strike call, does that result in a profit? Does that result in a cash outlay or does it result in cash received? So you sell a lower strike and you buy a higher strike. Lower strike costs more than higher strike, right? For a call, so you're going to receive money compared to bull spread. So again, you short a call at the lower strike, you long a call, the resultant is this, right? Horizontal and horizontal, downward sloping and horizontal gives you downward sloping, downward and upward evens out to horizontal, okay? So again, there's only one break-even point. So what is your break-even point here? Can you see from the graph? What do you think your break-even point is? Your break-even point is to the right of your x1, right? So it must be your x1 plus what? Plus C1 or minus C1? Okay, break-even point is to the right of your x1, right? So you know x1 is there. So x1 plus minus your 2 premium, right? Okay, 1 you receive, 1 you pay. So which one did you receive? C1 or C2? you buy the higher strike, you sell the lower strike, right? So it becomes x1 plus c1 minus c2. Okay? Is that clear? Now we can also use do the same thing using puts as well. So we've looked at a bull spread and a bear spread using calls. We can also look at the same thing using using puts. So let's look at a bear spread using put. So again, you buy a put with a higher strike, you sell the lower strike. Okay? Now as compared to bear spread using calls, you receive money, right? But with a bear spread using put, you're going to pay money. Okay? Everyone understands why? Because with a bear spread, you short the lower strike, you buy the higher strike, right? So if you use calls, the lower strike is going to be worth more than a higher strike, right? Yes or no? Yes or no? Yes or no? Okay, bear spread, right lower strike, buy higher strike. Now a call with a lower strike is going to be worth more than a higher strike, right? So a bear put using calls is going to result in money collected, right? A bear spread using put is going to result in money being paid out, right? Because a higher strike put is going to cost more than a lower strike put, right? Okay? Now aside from that is quite similar. So that's to tell you that in deciding whether to use calls or puts, you have to again weigh the costs and the benefits, okay? So the profit equation again is very similar except flipping the payoff for your option, okay? Instead of S minus X, it becomes X minus S now. You still have 3 profit formula because there's 2 strike prices, right? So everything is the same except the payoff, and you're using a put, so therefore one is in capital outlay, the other one is inlay. Okay, before, this might help you in your exam, okay? Sorry, not exam. Exam is quite far away, right? This might help you in your assignment, okay? Now, if you use, so, okay, tell me bear spread, how does it look like? Like this, right? Okay? So bear spread. Now, let's say you use calls here and you use puts here. So x1, x2, x1, x2. So with a bear spread using call, you receive premium or you pay premium? Receive or pay? I heard someone say pay. Okay, you sell a lower strike, buy a higher strike. So you receive premium or pay premium? Receive, right? Same thing. With a put, do you receive put premium or pay put premium? You sell the lower strike, buy the higher strike. Which one is going to cost more? Higher strike, right? So you pay premium. Okay, so this is the first thing you have to be conscious of. Now, if you use a call, which one is going to be in the money first? So which one is going to be in the money first? X1 or X2? X1 is going to be in the money first, right? Which means your obligation is going to come first, right? So you're going to have to deliver this before you're in the money, right? Now, using a put, which one is going to be in the money first? X1 or X2? X1 or X2? Okay, think about it this way. If the stock price is here, they are both out of the money, right? If stock price is in between these two, this is in the money, this is out of the money, right? Now, by the time stock price comes here, both are in the money, but this is already in the money before this, right? So this is deeper in the money. So which one comes first, obligation or right? your right comes first, right? Your right of exercise comes first, right? Whereas this one, your obligation comes first. Okay? So what does this mean? Well, this means that in terms of cost, you're going to receive money here, but you're going to pay out money here. In terms of benefit from the payoffs, you're going to receive this first and then this second, right? So while you receive the premium, you're going to have to wait for your profit. The other one, while you pay for the premium, you're going to earn your profit sooner, right? So there is a trade-off. So in deciding which one to use, you might want to think hard about this, okay? Okay, next we look at a collar. Now, some of these strategies here can be quite useful in your assignment, although you, in all likelihood, you won't be using all of them because some would be more complicated than necessary. Okay, but the basic ones can be quite useful in your assignment. Okay, so a collar now combines the underlying, a put, and a call. Okay, we so far looked at combining underlying with call or underlying with puts, right? In the case of a written call, covered call, and in the case of a protective put. So now we're going to combine underlying calls and puts in what is called a collar. Okay, now collar is a neutral strategy. So you long stock, long put with a lower strike, sell a call with a higher strike. So if you look at the strategy here, where do you think your strike price is going to be? So essentially what a collar is trying to do is it's trying to protect your profit, right, with a put. At the same time, it's going to reduce your cost by writing a call, okay? Now think about that. If this is what you're trying to achieve, where is your X1 and where is your X2 relative to S? To protect your profit, what do you have to do? You buy a in or out of the money? So let's say S is here, right? You want to protect your profit from dropping down, right? So you long a put. So S is here. You long a put at the bottom, right, to protect your profit, and you sell a call higher up, right? Because if you sell a call lower down, it's going to be exercised on you, right? Can you imagine this? Now, if the stock price is here, you long a put here, it protects the downside, right? This is the level, okay? You long a put here, it's going to protect the downside, right? If the stock price goes down, you can exercise your put. Now, you also want to write a call to save on some of the premium you have to pay here, right? So if you write a call, you're going to write it up here or down here? You want to write it up here, right? Because if you write it a call down here, immediately your call is in the money, right? Somebody can exercise it, right? So you write a call up here so that it doesn't get exercised. If it gets exercised, it means you have made more money on your stock as well, right? Okay? But at the same time, the call premium is going to cover part of the put premium, okay? Now, if you can find the strike such that this equals to this, the call premium that you receive equals to the put premium that you pay, then it becomes what is called a zero cost collar because the two premiums cancel each other out. Okay? Actually, I can do this, isn't it? And that way you won't forget to flip, right? It's both on at the same time. Okay. Okay, so again, you have two strike prices, right? X1 for your put, X2 for your call, so you have three profit formula. But now, notice that because you have three different instruments, you have three components here, underlying, put, and calls. Okay? So always write out this basic profit equation first before you account for whether the option is in or out of the money. Okay, this is simply to show you that the collar payoff exceeds the bull spread payoff by the difference between X. Now, how do you work this out? This is quite similar to your payoff table. But you have to look that way now. Okay. Okay, so what you can do, this is similar to your payoff table. So this is your bull spread, right? Long, a lower strike, short, a higher strike. Now this is your collar, right? Long underlying, long lower strike put, sell higher strike call. Okay, so this and this cancels out. Write out the payoff. You find this statement holds. Okay. So we look at a butterfly. Now a butterfly is what kind of strategy? Is this a neutral strategy, bullish strategy, volatile strategy? What do you think? This is a long butterfly. Now, it's a small body, right? So if it's a small body, it tells you that this is a neutral strategy, right? Okay? And it also tells you that your losses are capped, okay? So we go through the profit formula first. So you know that large stock prices are unlikely, so you use a neutral strategy, right? Now, remember, if large stock prices are unlikely, then you would choose strike prices which are close to at the money strikes, right? Because it's not going to deviate by much. Now, if stock price movements are large, then you can choose further away strike because it's likely to materialize. Now, if large movement is unlikely, then it's going to move in a small range, right? So if it's going to move in a small range, you will have to choose strike prices which are at the money where the stock price is right now. Does that make sense? Okay, because if you choose too far away, it's not going to get hit. Okay, so it's taken by going long a call at strike X1, long another call at strike X3, and short two calls with strike X2. Okay, so now that you have how many strike prices? 1, 2, 3, right? You have 3 strike prices, you're going to have 4 profit equation. Okay, but the basic equation is always the same, the payoff of your calls. Okay, payoff of call 1, payoff of call 2, payoff of call 3. Okay, and 2 here because you sell 2 calls, right? This is your NC. Okay, this is 1, this is 2, this is 1. Okay, buy 1, sell 2, buy 1. Okay, so work out your profit formula. Again, you find that there are 2 formulas here which has got ST in it, right? ST, ST. Now all this has got no ST. So given that there are 2 ST formulas, you know that there are 2 break-even points. Okay? So there you go, you have 2 break-even points. Okay? So you long 1 call, you short 2 calls. If you had short 1 call, it would be horizontal here, right? But you short 2 calls. So you can work out the maximum profit and break even. But what I want to show you is this. Now we talk about bull spread here, right? We talk about bull spread here. Now, okay, you have 1 bull spread. So what? Long 1 call, short 2 calls plus long one call, right? This is a butterfly, right? Long a lower strike, short 2 medium strike, long 1 more higher strike gives you a butterfly. Now if you split this into long 1 minus C2 and minus C2 plus C3, this also gives you a butterfly, right? But you split it into two components, right? So if you split into two components, what is this and what is this? This becomes a bull spread, right? And what is this? This is a bear spread, right? But this is C2 and this is C2. So it means that it's the same strike price. So therefore, this and this is the same, right? Yeah? So if you move these two together to combine them such that this meets this, then it's going to look like this, right? Yes? Okay, a calendar spread is essentially a time spread, right? So it bets on time value decay. Now, because it bets on time value decay, you are then now looking at two different expirations. And when you look at two different expirations, you won't be able to come out with a profit diagram, right? So far, all the strategies have are assumed to expire. So when you look at a calendar spread for which you try to earn time decay, then you have to bear in mind two important things, right? One is you're betting on volatility. So if you're betting on volatility, what strike price do you want to take? Deep in, out of the money, or at the money? Remember, with time spread, you stay at the same strike for both options. The difference is the option expiration. Okay? So which strike price do you want to use? Deep in, out of money, or at the money? Given your understanding of time value. You want to choose a strike which is at the money, right? Because that is where time value matters most, right? And which one do you want to go long, which one do you want to go short? You have to go long on one, go short on the other, right? So to think about that, you want to think about how does time value erodes? When does time decay happens fastest? Now, time value loses the most when the option is about to expire, right? So is that good for a long position or bad for a short position, or good for a short position? It's better for a short position, right? So you want to short the near man, you want to long the far man, okay? So always try and reason that out, and then you won't go wrong. Okay. So you can do the same with puts as well. So we look at one more strategy called a straddle. Okay, a long straddle is a volatile strategy or a neutral strategy. So the chart looks like this, right? So how does it become like this? So you long an equal number of calls and puts, right? So if you long a put, how does it look like? It comes down like this, right? And if you long a call, it looks like this, right? Now, if these two strikes are different, okay, then this is going to become like this, right? Yes? If these two strikes are the same, then it's going to look like this, because this meets this, right? So it becomes like this, okay? So this is your long straddle. So with a long straddle, you can therefore see that your losses is capped, but your profit is unlimited, right? Okay? So this is useful for a volatile strategy because volatility means it can go either way, right? Up or down, but your downside is capped, so you can ride on the upside. So this is a long straddle. Now a short straddle would be the other way around, right? So if it's a short straddle and it's the other way around, your losses are unlimited, right? But your profit is capped. Okay? So be very careful whether you go long a butterfly or short a butterfly, whether you go long a strangle or you go short a strangle. It makes a lot of difference. Okay? Okay, finally we look at two other things before we wrap up the chapter, and these are straps and strips. So you find that you can combine it in any manner for any strategy. Now, however, if you think that it is more likely to go up than go down, but you're not sure, right? But you incline towards being bullish than being bearish. So what kind of chart do you want to see? Do you want to see a less steep downward sloping and a greater or steeper upward sloping? So okay, this is basically the same, right? Roughly. So you more or less equal about whether it's going up or down. Now, if you think that it is more likely to go up than go down, so do you want this thing here to be less, or do you want it to be greater? Which one? 1 or 2? 1 or 2? 1, right? So this is the idea of a strap and strip. Okay, so if you want it to be, instead of going up like this, you want it to go up like this, then all you have to do is you double this position compared to this position, right? Okay? And if you want it to, if you think that it's going to come down more than it's going to go up, then what do? Then you want this person to be like this or come down faster. You want it to come down faster, right? So therefore, you want something like this, right? So then you double this position and you... Okay? So you can use calls, you can use puts, whatever you want to do, okay? So depending on whether you think it's going up or going down, you will then therefore double calls compared to put or double puts compared to calls, okay? Okay, so you bet it's going down, you double your puts compared to your call. If you think it's going up, you double your call compared to put, and therefore that's a strap. Okay, so far we have looked at a number of things. We have looked at how to combine positions using stocks and calls, stocks and puts, calls and calls, calls and puts and puts, stocks, calls, and puts, right? Different combinations. So, excuse me. So that effectively wraps up today's topic. I'll open the floor to assignment. Anything that you want to talk about the assignment, I'm happy to explain. So this is your assignment, right? It's worth 20%. Now remember this, it is initially intended as well, it is still an individual assignment, okay? However, to encourage you all to learn to collaborate, to have teamwork and all that stuff, now you notice that the course outline says it's individual, right? So I've said that you can also work in a group so that you can learn to collaborate with each other, okay? But I will not be able to help you sort out group members. So don't ask me for group members, don't ask me to help you find group members because I won't be able to do that, okay? Now, you have a choice. If you can't find a group member, go individual because it's supposed to be individual in the first place, okay? Now, so due date is 29 April. The first part is simply describes the the submission process. Very important is that if you submit a group assignment, make sure you put all the members on the first page, because sometimes the assignment cover sheet doesn't attach to your assignment. Okay, so make sure that it is all there. Any question on this part? No, right? So in your EVA assignment, now you have identified 6 stocks, right, with low PE. So what else do you do with those stocks? I mean, what is the exercise? Was that an academic exercise in the sense that you just learn to value stock based on fundamentals, or what is the objective? What is the objective? Were you supposed to do anything else after you identified the stocks? You got to tell me, right, so that I can guide you accordingly. Based on PE. How do you identify mispriced stocks based on PE? Can you? Okay, in working out, so you identify 6 stocks based on low PE. Now, when you calculate the PE ratio, what earnings do you use? Do you use historical earnings? Because the denominator is your earnings, right? So do you use historical earnings? Do you use future earnings, current earnings? Do you smooth out the earnings over a period of time? What is it that you do?
Remember, we've done regression for revenue.
Yeah, but you still need to determine how you account for earnings, right? So you have to think about that, okay? So the first thing is, to do part 1 is very simple, okay? Now, part A, you simply have to determine the returns. Now, with that 6 stocks, assume that you have created a portfolio comprising of that 6 stocks, okay? And that you're invested in that portfolio. So investment will start from sometime last semester, right, when you submit your assignment, okay? So you have to determine the cost at that time, right? So assume you are invested in that portfolio, so that is at least 6 months away, right? 6 months into the past. So what was your cost at that time? And determine at today's price, whether you start writing up today or tomorrow, whatever, at today's price, whether your portfolio make a profit or loss. So 2 assumptions exist here. One is that you are invested in your portfolio. The other one is that this is a buy and hold portfolio, right? Because you held it since then, right? You have not actively rebalanced your portfolio, right? So it's a buy and hold strategy. So then part A, based on your cost at that time, compared to the price today, did you make a profit or loss? Now, it is not as simple as that. When you calculate your return, what return do you use? Okay, you have to think about whether you should be looking at nominal returns or whether you should be looking at real rate of return, whether you should benchmark your return against the required rate of return, which is the discount rate, right? Or should you benchmark against the risk-free rate? Now, the discount rate means that when you value a company, and hence by extension is stocks, what you're doing effectively is that you are discounting future earnings into the present at a discounted rate, right? Now that discount rate essentially is your required rate of return, right? So then when you calculate your return by comparing cost to today's price, then you have to think about, are you going to benchmark against the discount rate, or are you going to benchmark against the risk-free rate, or are you going to benchmark against some other rate, right? And before you benchmark, of course, you need to think about whether you are calculating nominal return or real return. And part B is to evaluate the feasibility of your portfolio in terms of using PE ratio as a method for stock selection, Because effectively that's what you did, right? You use PE ratio, you identify the stocks, and then you create a portfolio. So you're saying that you have used PE ratio to select your stocks. So determine whether that is a good approach or not, and determine whether buy and hold strategy is a good approach or not. Okay? Now, in order to do that, you then need to discuss how PE ratio. Now, I guess you don't have a choice whether you think it's a good method of stock selection or not, because you are laden with that portfolio anyway, right? As part of your EVA assignment. So even if you think that is a lousy means of identifying stocks, then you just say that it's no good, and why it's no good, right? But if you are convinced that PE ratio is the way to go to select stocks, then you have to explain why you think that's the way to go. Okay. Now, so likewise with a buy and hold strategy. Now, I'll give you some tips on what you can think of when you think of the feasibility. One of them is you need to think about, I don't have to write down because I'm recording it. So one of the things you can think of is, does fundamentals actually help you to determine the future return of a stock, because that's what you're interested to do, right? Then you can fall back on several concepts that you learned before. You can fall back on, for example, now you don't have to do what I tell you now. These are just ideas to help you to think, okay? And not necessarily the correct answer, okay? So you can think about things like efficient market hypothesis. You can think about random walk and how that leads to the conclusion that stock prices are unpredictable and therefore market timing is useless. So therefore buy and hold strategy is the way to go, right? By extension, that's what it means, right? Now you could also think then on the other side of the fence and say that, well, behavioral finance plays a part too, because you have market spikes, you have bubbles, and so on and so forth. And why does that happen? Well, because people trade not based on fundamentals. It could be due to behavioral aspects such as herding, you know, and therefore they drive the price up to beyond fundamental value, and it will then collapse, right? So therefore, if you use fundamentals, maybe that's not the way to go, right? Now, you could also think of mean reversion, because it will eventually mean revert. So there are many different aspects that you can think of to justify or to reject both the stock picking method as well as a buy and hold strategy. Now, at a very basic level, you can think about this. Why is a buy and hold strategy? Okay, how many of you think buy and hold strategy is the way to go? Just show your hands. Never mind if you're right or wrong. One, only one? Only one. Okay, so if you buy and hold, then you're just going to simply buy at whatever price, right? And or rather, you're going to ignore prices going forward, right? So what does that imply? Prices do not matter? If the price drops down or the price goes up a lot, you don't want to take your profit? You don't want to cut your loss? You learn a lot of techniques where you can mitigate your loss, right? Protect your profit, right? So you're going to be passive about that. Does that mean, therefore, that prices are irrelevant? You know, so these are things that you want to think about in helping you to answer part B. Okay? Any question? Okay, no question. We move on to second part. So second part here means out of the 6 stocks that you have, okay, you pick the worst performing stocks. So either it loses the most money or make the least profit. Okay. Now, if you're so good that all 6 stocks makes profit, then you choose the one that make the least profit. Okay. So only one stock, worst performing stock. Okay. And okay, before I forget. Before you even start the assignment, make sure you collect daily prices of your options and stocks. Okay, that is very important. Now, you don't have to start writing now, right? You only need the data. Now, if you write, it probably take you a very short period of time to write up the assignment, right? You don't need 3 weeks to write up an assignment. So, but what you do need is all the prices. So you should start collecting, if you have not already done so, start collecting today all the the stock prices for your portfolio and its related options. Now collect both calls and puts because you don't know what you want to do, right? So collect daily prices every day until, well, for 3 weeks, right? So that when you write, you're able to have the data on hand, okay? So that is very important. If you don't do that, you're not going to be able to do your assignment, okay? And you know, if you can't find it on the internet or on exchange websites and stuff, a lot of people can't find it too. So your friends won't be able to help you as well. Okay, so make sure you collect that. Okay, so part 2, based on the worst performing stock, hedge that. Okay, so by hedging that, well, it can mean, well, you actually hedge that by mitigating the loss if you had made a loss, or you protect the profit if it has made a small profit, right? So you can think about you can use simple calls and puts, or you can think about the strategies that we talked about today, right? I mentioned covered call, protective put, but you don't have to do that if you want to do something else, because there are other things you can do as well, such as maybe a collar can be useful too. So think about the strategies that you learn and which one you want to do. So part A is you use the option prices for the same day that you determine your profit or loss in part 1. So if you determine your portfolio profit or loss today, then your starting point for item 2 and 3 is also today. Okay? So use the same option prices as the day that you determine your portfolio profit or loss, and work out the optimal number of positions in the calls or puts based on the strategy that you use. So what that means is that you would need to then think about what is it that you're trying to do. Are you trying to protect your profit? Are you trying to hedge against losses? You're trying, and if your worst performing stock is still profitable, are you trying to continue to write on the profit? What is it? What is your objective? Right? Given your objective, then you can determine which strategy you want to use. Okay? Now I want you to follow the flow. Okay? Now, so once you know which strategy to use, you want to think about how that strategy is going to achieve your objective. Okay? So this is the conceptual part that you have to think through. Now the calculation part, as with most part of the course, is fairly simple, right? Once you know the strategy, then you can work out the calculation, right? How many calls, how many puts, what is the value of your worst performing stock, how many position in calls or puts you need to do, and remember you're not doing delta hedging, so therefore you're not doing hedge ratio, right? So your calls and puts therefore is now based on your contract multiplier, right? Because it's a partial hedging of risk. Now, given that it's a partial hedging of risk, that's one thing you can talk about too in part C, right? So at the conclusion of 2 weeks, evaluate the effectiveness. Effectiveness means evaluate in terms of your objective, whether you have met your objective or not. And reasons for your success or failure, you can look at the market and look at your strategy. If your strategy is, let's say, a bullish strategy, what is the market condition in that 2 weeks? Was it bullish? If it's bullish, then perhaps you've adopted the right strategy. If it's bearish, then your strategy is perhaps wrong, right? So you can think of that. Reasons for success, failure is quite simple. I've just given you one. You're hedging only partial risk, right? Another one you can think of, falling back on your fundamentals, is that if you use contract multiplier, it may not cover your underlying position perfectly, right? Because if you assume 100,000 distributed to 6 stocks, maybe your worst performing stock comprised of, let's say, 17,831 pieces of stocks. But one contract is for 100, right? So how can you cover 17,831? It's not a full match, right? So that's another reason you can think of. So if you fall back on the things we talked about in the lecture, there are actually many aspects you can use for the assignment, and every lecture I think I did mention something that you can use. Maybe you don't realize it, okay? But every lecture I mentioned something to help you along. Okay, so any question on part 2? If not, we move to part 3. Okay, part 3 is quite the same. Again, starting point is the day that you liquidate or you determine the profit loss of your portfolio. And you use, so that's your starting point. Again, you work out your strategy, work out the number of calls or puts. But the difference between 3 and 2 is that now you assume that you liquidate your worst performing stock in part 1. Okay, so let's say that fetches you $13,500. Now with that $13,500, decide whether you want to go long or short, call or put. Okay, invest that fully into it and evaluate the results. So the idea, the broad picture for the assignment is this. You are laden with a portfolio from your EVA, right? Good or bad, that is your portfolio, right? So you explain whether that is a good portfolio or bad given that stock selection method, given that that buy and hold strategy. Okay, then it flows through to item 2, which is that, well, if you are laden with a portfolio that gives you at least one stocks that don't perform, then what can you do with that stock? Okay, so that is in item 2. Do you want to hedge that? Do you want to protect that? Do you want to do damage control? What can you do, right? So imagine this. Suppose you inherit something, so you can't change that, right? Because you basically inherit your EVA portfolio, so you can't change that. So, but what can you do going forward? It doesn't mean you continue to stay at a loss, right? So part 2 asks you what can you do with it. So you can hedge, you can protect, you can do damage control. Part 3 offers you an alternative. Now suppose you don't hedge, you don't do damage control, okay? You cut your loss instead. Cut your loss, take that money, do something else. Are you better off? Do you follow me? Is that clear? Is the overall picture clear to you? Yes or no? Yeah? So I hope you enjoy the assignment because I think it will help you to think through the investment process. It will help you in your real personal investment as well, okay? Because it's very applied, okay? If you do your research well, I think you will enjoy the assignment. You will learn a lot from this, okay? Because it's not just theory. Okay, any questions that you want to ask? Some people ask me about if they work as a group and all 3 members have got different portfolio of 6 stocks, which one do they choose? Which one do you want? Look, you're supposed to do your own one, right? Now that the 3 of you come together and decide to work together, then the 3 of you decide which one you want to choose. Okay, I mean, I'm not going to ask you to work on all 3, right? Then you're doing 3 individual assignments. So let's say the 3 of you work together and the 3 of you have 3 different portfolio of 6 stocks. Then you discuss which one you want to use. Okay, and if you pick, let's say you pick you in the denim jacket, then you'll be the team leader. Okay, so when you submit your assignment, I know that the portfolio is based on your EVA assignment and not the other 2 persons. Okay, does that make sense? Does that help you? Use what?
History data, not just from
No.
now.
No. It defeats the purpose, right? The idea is I want you to go into the market and apply what you learn. And you notice that it's not just about options, right? It's also on a broader finance theory as well. So if you use the previous, then it defeats the whole purpose. You must always look forward, not look back. Okay. So therefore, very important you collect your prizes. Okay, but effectively you're looking back, right? Because if you collect your prizes today, and after you start writing after 2 weeks, effectively you're using historical prizes, right? Although not as far back, right? Okay, so enjoy your assignment. If you have any questions, feel free to come back to me or something.